Welcome back to Smart Stock Sam, the channel where we cut through the noise, read the charts, and find the plays before the crowd even wakes up. I'm Sam, and if you're watching this before April 29th, you are exactly where you need to be, because what I'm about to break down could either make bold investors a serious amount of money or save the unprepared ones from a devastating loss. Here's what we're covering today: a stock sitting on record-breaking revenues, getting crushed by a short seller attack, squeezed between a death cross and a buy signal simultaneously, with 165 million shares sold short that could snap back violently, all of it heading into a binary earnings event in less than a week. That stock is SoFi Technologies, and by the end of this video, you'll know exactly where the key levels are, what the smart money is doing, what one deeply ignored warning signal could flip the entire thesis, and what price targets you should have on your radar right now. Stay to the end, because the warning light I'm going to show you is something almost no one is talking about, and it changes everything. Now, to understand where we're going, we first have to sit with the absolute contradiction that is SoFi's current reality. The stock is trading at $18.44. Over the last 12 months, it's up nearly 44%, a legitimate growth story. In the fourth quarter of 2025, SoFi crossed the $1 billion quarterly revenue mark for the very first time in its history. That is a milestone most fintech companies never reach. Think about what it takes to build a fully digital bank from scratch and hit 10 figures in a single quarter. And yet, year to date, the stock is down 32.85%. How does a company hit its greatest operational milestone in history and still lose a third of its market value in the same breath? The answer is volatility, and SoFi has it in abundance. With a beta between 2.24 and 2.31, this stock moves more than twice as fast as the broader market in both directions. On the upside, that's exhilarating. On the downside, it's devastating. Management is projecting significant net income growth for the rest of 2026, but the market is pricing in fear. So where did that fear actually come from? If we trace the price action from the November 2025 peak, the stock was already drifting lower. Broader fintech weakness, deteriorating geopolitical environment, classic risk-off rotation, all macro pressure. Nothing specific to SoFi. That changed on March 17, 2026. That's the day Muddy Waters Research dropped their report, and it hit like a hammer. The stock tanked sharply. But here's something the bears don't want you to focus on. CEO Anthony Noto immediately went into the open market and bought shares with his own cash. The dip was absorbed. Then, the broader US geopolitical situation escalated further. The conflict environment pushed another wave of risk-off selling, and SoFi drifted back down. Right now, we're in a pre-earnings recovery attempt, clawing back toward 1844. But think about this. Would a CEO personally buy shares in the open market during a short seller attack if the allegations had any real merit? What are the chances that one of the most scrutinized executives in fintech is doubling down on fraud? The odds of that seem almost impossible to believe. So what exactly was so toxic in that Muddy Waters report? It comes down to two narratives in direct collision. On the bearish side, Muddy Waters is alleging improper accounting on a $312 million JP Morgan loan, and they're suggesting SoFi may need to reverse up to $1 billion in EBITDA. That is a headline number designed to terrify. Management has vigorously denied every claim as baseless, but the market doesn't forgive doubt easily. On the bullish side, the business is genuinely accelerating. SoFi is moving into big business banking. They just launched a fully digital home equity line of credit to tap into the massive home equity market. They became the first US chartered bank to support XRP deposits. The operational momentum is real and measurable. Two stories, one stock, and right now, fear is winning. But is that about to change? Let's run the technical diagnostic. The bad news first. We are in an active death cross. The 50-day moving average crossed below the 200-day back in March. That is the chart pattern that signals a damaged intermediate trend and typically invites more institutional selling. Now the good news, the MACD is turning positive for the first time since the breakdown. That means buyers are finally gaining traction at these levels. The RSI is sitting at 58. That is the sweet spot. Enough momentum to show conviction, but not overbought. There is still room for this stock to run higher before hitting a ceiling. And that ceiling? It's closer than most people realize. Here's exactly where SoFi is sandwiched right now, and the geometry of this setup matters enormously. The current price of $18.44 sits just above the 50-day moving average at $17.80. That's our immediate safety net. Think of it as the floor of the trading range. If we lose that level on a closing basis, sentiment deteriorates fast, and the next historical support floor is around $16.50. That becomes your hard stop zone. But now, look at what's above us. The 200-day moving average is sitting at $23.80. That is 21% above where we're trading right now. In technical terms, that is a massive wall of overhead resistance. Sellers who bought anywhere near that level are underwater and will use any rally as a chance to reduce their losses. Until SoFi punches through that wall on high volume, every bounce will be called a dead cat rally by the bears. The bulls are trapped below a ceiling. The bears are sitting on a hair trigger below. The only thing that can definitively resolve this standoff is a catalyst, and that catalyst is 4 trading days away. Wall Street analysts are genuinely split, resulting in a consensus hold rating. On the bearish end, firms like Keefe Bruyette and Woods and Bank of America have targets between $17 and $18. Their concern is credit deterioration in SoFi's loan book and a weakening consumer macro environment. But on the bull side, Citizens JMP is screaming buy with a $30 price target, betting on the flywheel of member growth compounding over time. The average consensus price target sits at $24.85, representing a 34% potential upside from current levels. Think about that for a second. Even the consensus, not the most optimistic view, just the average, implies 34% upside. Now let's talk about where the real conviction is showing up. Because while analysts debate, the smart money is voting with actual capital. Institutional ownership stands at 38.43%. And in the first quarter of 2026, we saw substantial accumulations. Zürcher Kantonalbank increased their stake by over 223%. Evergreen Capital jumped in by over 302%. And then there's the biggest signal of all. CEO Anthony Noto purchased 28,900 shares at an average price of $17.32 during the chaos of the Muddy Waters attack. When the man who knows every line of the balance sheet personally steps up to buy the dip during a public short seller assault, what is that telling you? Could a company actually be committing fraud while the CEO accumulates shares in the open market during peak scrutiny? What are the odds of that happening and ending well for the shorts? Which brings us to the short squeeze setup, because this is where things get genuinely explosive. Short interest is currently between 12.6 and 13.2% of the float. That is approximately 165 million shares sold short that must eventually be bought back. The days to cover ratio sits at 3.4, meaning there is not enough daily liquidity for all those shorts to exit simultaneously if good news hits. If the April 29th earnings report comes in with a surprise beat and the stock crosses that $20 resistance level, all 165 million of those short shares will start scrambling for the exits at the same time. That is the mathematical recipe for a compounding price spike. The options market is already smelling it. Call buying represents over 68% of total options activity. There is massive open interest in the $22 calls for May and the $25 calls for August. Those are not retail lottery tickets. Those are institutional bets that align almost perfectly with that $24.85 consensus target. But here's the critical question every SoFi bull needs to answer honestly. Right now, SoFi is classified by the market as a fintech lender. And that's a problem, because 70% of their revenue is still driven by personal loans. That makes the entire business highly vulnerable to any slowdown in consumer credit quality. To earn a premium valuation, the kind that justifies a $30 price target, SoFi needs to complete the transition from fintech lender to financial infrastructure provider. They're working on this through their Galileo technology platform, their FedNow integration, crypto banking expansion, and their push into business banking. They want to be the AWS of finance, a platform company, not just a bank. And this brings me to the warning light I promised you at the start. The one thing almost nobody is watching closely enough. SoFi's flywheel has 13.7 million members using over 20 million products. The more products a member uses, the more profitable they become. That's the thesis. But inside their latest data, the Galileo technology platform accounts just posted a 23% decline. Read that again. If SoFi's entire re-rating story depends on becoming a financial infrastructure provider, what happens to the valuation if the infrastructure business is actually contracting? This is the #1 metric you need to watch in the April 29th results. If Galileo continues to decay, the infrastructure narrative collapses, and analysts who are holding or buying based on that future premium will have no choice but to reprice the stock lower. Everything else can be perfect: revenue, members, net income. And this one metric can still sink the ship. Now, assuming they can fix Galileo, the profitability path is genuinely staggering. Management is projecting $825 million in adjusted net income for full year 2026. That is a 72% jump in a single year. Let that number sink in. 72% growth in net income at a company that already crossed the $1 billion quarterly revenue threshold. The top-line growth has already been proven time and again. The challenge now is a different kind of discipline, maintaining credit quality in that personal loan portfolio, the 70% of the business that is most sensitive to economic stress, while simultaneously growing net income by 72%. If they can thread that needle, if default rates hold and the revenue engine keeps firing, this stock at $18 will look like the opportunity of the year in hindsight. If credit cracks appear, every other positive metric gets called into question. So here is the exact trade setup. The entry zone is between $18.15 and $18.45. If you catch a dip to the 20-day moving average, around $17.85, that's an even better entry. Primary support is at $17.80. If that breaks, your historical floor is $16.50. That's your hard stop zone. To the upside, first resistance at $19, then the major psychological barrier at $20. Conservative target is $20.50. The real payoff is $23.80. where we reclaim the 200-day moving average. And if we break through that, the $30 long-term target becomes a legitimate destination. Everything, and I mean everything, hinges on April 29th. If SoFi delivers an earnings beat, the flywheel accelerates, and Galileo shows stabilization or growth, this stock reclaims $20. The short squeeze ignites, and we're talking about a rapid move toward the 200-day moving average. If we see credit deterioration, continued Galileo decay, or the Muddy Waters allegations start finding traction, the stock gets rejected hard and tests $15. This is a binary moment for SoFi, record growth battling severe technical damage, and the Q1 report will set the trajectory for the entire rest of 2026. Before we wrap, I want to be clear, everything in this video is purely for educational and informational purposes only. Nothing here constitutes financial advice, investment recommendations, or a solicitation to buy or sell any security. Stocks involve risk. You can lose money. Always do your own research and consult a qualified financial professional before making any investment decision. Smart stock. Sam takes no responsibility for any trading outcomes based on this content. All right, here's the bottom line. SoFi is one of the most fascinating setups in the market right now. Record revenue clashing with a short seller attack. A death cross fighting a mass ED reversal, institutional accumulation fighting retail fear, and 165 million short shares sitting on a powder keg heading into earnings. The Galileo warning light is real. Watch it closely on April 29th. But if this company delivers, the squeeze potential is unlike anything else on the board right now. Now I want to hear from you. If SoFi beats earnings and Galileo stabilizes, what do you think happens first? The $20 breakout or the short squeeze? Drop your answer in the comments below. I read every single one. If this breakdown gave you value, smash that like button. It genuinely helps this channel reach more investors like you. And if you haven't subscribed yet, hit that button and ring the notification bell so you never miss a setup like this again. And hey, if Smart Stock Sam has ever helped you see a trade more clearly, consider showing your support by sending a super thanks right here on YouTube. It keeps this channel independent, unsponsored, and completely in your corner. This is Smart Stock Sam. Do your research, manage your risk, and I will see you in the next one.